I'm Politecnico di Milano.
Good evening, ladies and gentlemen. My name is Anna, and together with Francesca, Riccardo, Alessandro, and Gabriele, we make up the Politecnico di Milano team. We are going to introduce you an interesting investment opportunity, Diasorin. We are going to go through company strategy and market trends, financials, valuation, and risk assessment. We initiate a buy recommendation with a year-end target price of 52.1 euros, as we think consensus is underappreciating the strong potential of Diasorin growth strategy and its competitive positioning.
With a market cap of 2.5 billion euros, Diasorin is a multinational company operating the 8 billion euros immunodiagnostics market. Diasorin is a high-growth company. In the past 10 years, it has grown at twice the pace of its reference market, maintaining strong margins and cash flow generation. But let's be clear, what is exactly immunodiagnostics? Such a complex word represents nothing but the market for blood tests. In particular, Diasorin focuses on specialty tests for low-incidence diseases that command higher prices. Diasorin operates in a niche market. In its main clinical areas, market shares range from 2% in bone and mineral to 46% in vitamin D. And vitamin D success, when Diasorin was the only provider in the US market, left a heritage of more than 6,000 testing machines placed in hospitals and labs. Nowadays, both the company and the industry are living a positive phase. The ID market is growing at 7% CAGR, driven by trends such as more tests per capita as focus on prevention growth, aging of the population, and increase in healthcare expenditure. On the other side, the growth could be constrained by budgetary pressure and consolidation among clients. Also, the level of competition in the market is quite high, but is mitigated for Diasorin, since the company focuses on niche and innovative areas. Diasorin has always had a clear business model. It operates a true result-based model, such as Gillette and Nespresso, placing machines for free in exchange for a granted amount of test sales per year. As for the strategy, it is based on three main pillars: continuous innovation, tailored commercial strategies in different markets, and stabilization of vitamin D franchise. All these allow Diasorin to be one of the most profitable companies in the market, despite being one of the smallest players.
Now you know both the business and the strategy. But to understand the future, we must look also at the past. In particular, we see three phases in Diasorin history. In phase 1, from 2006 to 11, Diasorin experienced a 20% CAGR thanks to its leadership in vitamin D. In the same period, gross margin benefited from rich vitamin D test prices, reaching an all-time high of 71%. In phase 2, revenues flattened. Clear test acceleration compensated the decline in vitamin D, as new big players entered the vitamin D market competing on prices. At the same time, gross margin lost about 4 percentage points, touching a low of 67%. In phase 3, finally, we see a return to growth. Vitamin D business has started growing again in mid-2015, and the successful launch of new CLIA test is bringing the company back to a double-digit sales growth and improving margin trend. We expect Diasorin to end 2015 with 500 million turnover, a best-in-class 39% EBITDA margin, and a strong 35% return on invested capital. We are now ready to glance at the future. We expect a far more successful growth than the market factors in. Revenues will grow 11% CAGR up to over 800 million by 2020, with the EBITDA margin improving by 2 percentage points and a strong cash generation. Our estimates for 2017 revenues and the EBITDA are respectively 15% and 21% above consensus. This is a top-line driven story. But how did we come up with those estimates? Alessandro, did we dream about them?
Of course, we are not dreaming. We are so more aggressive because we didn't just follow the company guidance, but we performed an in-depth analysis. How exactly? Well, we started breaking down sales by clinical area, and we discussed with the management to assess DiaSorin strategy. Hence, we understood the clinical areas on which DiaSorin is focusing its R&D and the commercial strategies for the different markets. Once defined the starting point and the strategic intentions, we forecasted revenue potential through the following 3 steps. First, we selected representative tests for each clinical area. Second, we assessed the potential total addressable market, looking carefully both at disease-specific drivers and macro trends, the ones previously listed by Francesca. Third, we pondered additional factors that can affect DiaSorin market shares, namely new test launches, commercial partnership, and approval of tests in other countries. Pulling all together, DiaSorin growth will be fueled by the stabilization of the vitamin D franchise and by the strong growth of the other tests. Let's now look at the vitamin D example. From a market analysis, we see volume opportunities thanks to agreements with megalabs. Moreover, the test price has already reached a commodity test level, and we do not expect any further erosion. Among the additional opportunities, I'll mention the Japanese one, where DiaSorin is the only approved provider. Japan will be, in 10 years' time, a market for vitamin D as big as Europe, and including this opportunity, DiaSorin will end up to improve its market share in the global vitamin D market. So, summing up, Gabriele, we are not dreaming. Thanks to our own detailed analysis, we see a much stronger growth than consensus. Revenues will grow at 11% CAGR up to over 800 million. EBITDA margin will exceed 40%, and return on capital will reach again historical peak levels.
For our evaluation, we achieve a €52 target price relying on a DCF model, which embraces the estimates we have just seen. We opted for this methodology because DCF is the best approach to consider the strong revenue acceleration that we foresee. In particular, we opted for a 3-stage model in order to avoid overestimating terminal value in 2020, the year when we expect peak returns. For this purpose, we included a second phase that is a fading phase between 2020 and 2030. And finally, we computed a perpetuity value on a 2.6% terminal growth rate. We also performed a stress test analysis around our base case, and we found that 87% of cases supports our DCF conclusion. Nonetheless, we look for further positive feedbacks. The first of these one is the macro analysis. On our estimates, DiaSorin trades at a strong discount on both EV on EBITDA and price on earnings. Also, given DiaSorin net cash position, we think that its price can rise after a financial leverage. Debt can unlock value, reducing the 7% WACC that we obtain through a capital asset pricing model. In fact, weighting the trade-off between an optimal cost of capital and the financial flexibility required by the industry, we think that a net debt value around 3 times the EBITDA is plausible, and this will give us a further upside of 14%. A clever way to leverage would be to perform an active acquisition. DiaSorin has both the cash and the financial flexibility to do that. On top, past track record has shown a strong value generation from both a strategic and an industrial angle as well. An example is Murex acquisition in 2010. That was also the base for clear ex-vitamin D business development. So, to end up, we perform a DCF. We check it with a stress test. We look for further positive feedbacks in the market multiples, and finally we also analyze to add further financial opportunities. But Anna, is it all rainbows and unicorns?
Well, the future certainly looks good, but we have also to consider potential areas of risk. That's why we assess and classify them according to the likelihood and impact. In particular, we want to highlight the reimbursement risk, as it can put price pressure on the value chain and foster lab consolidation. DiaSorin mitigates this issue with a focus on specialty tests, as they are the least affected by reimbursement issues, and through commercial partnerships, such as the one with Roche here in the US and in Europe. Price erosion risk, because test prices are renegotiated every time an agreement is renewed. DiaSorin mitigates this issue with its continuous innovation on tests and being the first to market with government-approved tests, like it's doing right now in Japan for the vitamin D test. Technological breakthrough, because CLIA technology may be surpassed by another technology which is able to provide more rapid and accurate diagnosis. DiaSorin maintains a certain financial flexibility in order to be ready in case to buy new innovative startup or invest in R&D. So, wrapping up, DiaSorin is a compelling investment opportunity. It's accelerating its growth via innovation in a niche, less competitive growing market with a high cash-generating business model, and we also see further upside possibility. And all this is not yet appreciated by the market. So thank you for your attention. We are now glad to answer to all your questions.
You said they tested rare diseases, yet their biggest business is vitamin D, which is not a rare disease. What do they do actually? What is this business of vitamin D?
Vitamin D is very important for our health. It is related with the bone metabolism, and so it has a really great importance, especially when you are old. Vitamin D is related to the sun, and yeah, you're right, it's not a disease, but is the root of many diseases. So the business consists in analyzing a blood sample in order to understand if the process that converts vitamin D is actually working.
You talked about how your top line assumptions and your margin assumptions are significantly ahead of what the company expect and also where consensus is expecting. Where did you differ? I know you went through how it was built up, but what areas did you differ versus management and consensus and think they're simply too low?
The main difference between our estimates and consensus are actually in our method, because we performed a bottom-up approach analyzing very in detail most of the tests that this company provides. And we came up with our proprietary estimates that happen to be higher than consensus. According to us, the main factors that consensus might underestimate are the penetration of Japan and the sales from Japan, and the commercial partnership with the Beckman Coulter in China, where DiaSorin has launched last year his hepatitis and retrovirus panel, and in our estimates, this is going to be a real great hit.
One of your slides discussed the discount that they're trading to competitors, despite their high growth rates and strong return on invested capital. What do you attribute that to?
Sorry, could you rephrase just a little bit?
So one of the slides discussed valuation relative to some of the competitors, and they were trading at a discount on the two metrics, despite the fact that they have a strong ROIC and higher growth rate than most competitors.
Yes.
Why do you think the market has that disconnect?
Well, actually, the slide you're referring, the discount is based on our estimates, which are higher than consensus. Mm-hmm. If we look at consensus number for the same multiples, we can say that DiaSorin trades utterly in line for EV on EBITDA at a very slight premium for price on earnings. But having our proprietary estimation, which are higher than the consensus, the implied multiple for that price is actually lower. If the market continues to value DiaSorin with the same multiple, we will have an upside. And this is a supporting feedback for our buy recommendation.
Thank you.
There were a few very large pharma companies in the peer group, yet it's not a pharma company. Why do you compare them with Roche, for instance?
Yeah. That is true. Indeed, DiaSorin has no perfect peers. And this is one of the main reasons because of which we decided to perform our DCF valuation and to set the target price with that valuation, using multiple just as a supporting feedback. However, we selected different companies, starting from the competitive environment and the industry, selecting each company according to the most similarities with DiaSorin, with the main financial drivers that usually define a peer, which are growth, risk, and profitability.
In your earlier chart, you showed where a competitor had come in and impacted the growth in the vitamin D revenues. Where is the next risk in terms of revenues for this company then? And how did you factor it in your model?